putting Biden's executive order into action. Earlier this year, President Biden issued an executive order on ensuring responsible development of digital assets to align the U.S. government's regulatory approach in response to the ever-growing development and adoption of digital assets and blockchain technology. The order acknowledges that digital assets are a double-edged sword that brings significant benefits and opportunities, like financial gain, faster, cheaper cross-border settlements, and financial inclusion, but also presents equally significant economic, security, and environmental dangers. The order signals that the U.S. is prepared to wield this sword, but that a coordinated, whole-of-government approach is needed to both seize the benefits and guard against the risks. In the 2 months or so since the order, there has been much signaling and some action by various agencies. Shortly after the issuance of the order, in April 2022, Treasury Secretary Yellen delivered remarks on digital assets policy, innovation, and regulation and called for greater government regulation to police the growing crypto industry to prevent and prosecute fraudulent or illicit transactions. Yellen committed the Treasury to make policy recommendations, including assessment of potential regulatory actions and legislative changes, designed to support responsible innovation while managing risks. On May 16, contrary to rumors of turf wars between regulators, Securities and Exchange Commission (SEC), Chair Gensler noted in a speech at FINRA's annual meeting that the Commission is progressing in talks with the Commodity Futures Trading Commission (CFTC) to resolve some of the ambiguity regarding whether crypto is a commodity or a security, and therefore who has domain. According to the chair, the goal is greater oversight of and accountability by the crypto platforms, but one also hopes that agreement between the regulators will also provide much-needed clarity and a basis for a regulatory framework for the crypto industry providers to leverage. While legislation may still be in flux, the administration and federal agencies have made it clear that enforcement will be out in front, with a focus on fraud, cybersecurity controls, and sanctions compliance. Crypto-related enforcement frameworks and authoritative guidance consistently touch on these control issues, and regulators continue to prosecute wrongdoing across these areas. Expansion of digital assets enforcement resources. The SEC announced an increase of 20 additional positions in its Division of Enforcement Cyber Unit, now referred to as the Crypto Assets and Cyber Unit. The unit is tasked with enforcements within crypto markets and protecting investors from cyber-related threats, and according to Chairman Gensler, is positioned to be better equipped to police wrongdoing in crypto markets. Since its inception in 2017, the unit has brought more than 80 enforcement actions resulting in approximately $2 billion in fines and settlement fees, and going forward plans to continue its focus on investigating securities law violations involving crypto asset offerings, asset exchanges, asset lending, and staking products, DeFi products, NFTs, and stable coins. Focus on companies' accountability to protect against cybersecurity threats. The SEC stated it will continue to identify cybersecurity-related disclosure and internal control issues. Over the last 18 months, the SEC created increasingly stringent rules around the public reporting of cybersecurity events and is focused on the existence of what it deems acceptable security controls prior to an incident.